Well, good afternoon, everyone. My name is Joey Von Nessen. I'm a research economist with the Darla Moore School of Business at the University of South Carolina, and welcome to the mid-year market update. For the next hour, we're going to be going through an overview of South Carolina's economy, our outlook for 2025, and specifically, of course, focused on housing markets in South Carolina and residential real estate trends, and identify some patterns that we are seeing now and what we can look at for expectations about the second half of the year and even as we move into 2026. So I'm going to share my screen and hopefully everybody can see that. And just a quick housekeeping note before we get started. First of all, there's a link in the chat that you can click on to download this report that we'll be going through this afternoon. So you can have a copy of that. There's a PDF that you can download. And secondly, if you have questions as we're going through the presentation this afternoon, please go ahead and submit those in the chat. And then we will have a discussion at the end where we'll go through the questions and try to address as many of those as possible. So feel free to go ahead and drop those into the chat if you have those as we go through the presentation this afternoon. So as we get started then, and we begin to think through the outlook for South Carolina in 2025, and even looking ahead to 2026, a good place to start is really to get our arms around really the elephant in the room this year, which is this sense of uncertainty. Really, the theme for the state and the national economy in 2025 is uncertainty and pervasive uncertainty that has emerged this year and that has stayed with us as we moved into the summer months. And this is largely due to the back and forth that we've seen on trade policy and tariffs that have been introduced. And that has generated a lot of uncertainty for consumers and in the business community as well. Because in many cases, businesses, when they are faced with rapidly changing price structures or uncertainty about future market conditions, they tend to go into wait and see mode. Uncertainty often breeds paralysis, and so that's generated some changes to our economic landscape in 2025 that we're going to talk about. And one way to see this is just to look at the consumer confidence levels and how they've been shifting throughout the last several years, and that includes 2025. And so if we look at the Consumer Confidence Index, which is the broadest measure of consumer sentiment in the US economy, you can see that in 2025, we've seen a bit of a pullback. Hopefully you can see my mouse here. A bit of a pullback in consumer confidence, largely due to this uncertainty that has emerged. And that has been a very much a reality that we have seen. But it's also important to recognize that the uncertainty and the lack of confidence that the consumer has right now is not unique to 2025. It's true that the uncertainty has been introduced this year because of trade policy has influenced consumer confidence. There's no question about that. We can see it. But this lack of consumer confidence is not unique to this year and goes all the way back to the onset of the pandemic in 2020. And you can see here very clearly that consumer confidence levels have consistently been below where they were before the onset of the pandemic. So it's not unique to 2025. And in fact, if we look at the drops in consumer confidence over the last several years, one of the things that we'll see is that the biggest decline in consumer confidence took place not in 2025, not this year, not even in 2020, but rather between 2021 and 2022, which you can see here. So this is the same figure. We're introducing consumer spending on top of that. But if you look at this orange line, the biggest drop in consumer confidence occurred when inflation saw its biggest increase between 2021 and 2022, which is a very striking result given all the uncertainty that we were seeing in 2020 itself, right? Remember, the economy was literally shut down. We were all socially distanced. We didn't know what was going to happen next. We didn't have a vaccine at the time, right? So a massive amount of uncertainty in 2020. And yet we see a bigger decline in consumer confidence between 2021 and 2022. So what this tells us is that consumers really dislike inflation. And that has been a persistent undercurrent of the US economy and the economic landscape over the last several years. And that has been exacerbated by the uncertainty that's been introduced by trade policy in 2025. And you put those two together and you see low consumer and business confidence as a result. But that also begs the question as to why we've seen fairly stable consumer spending over the last several years and why consumer spending has held up fairly well, given the fact that consumer confidence has been so low and that consumers have lost a lot of purchasing power. As we can see here, consumer spending fairly steady following the dip in 2020, even though consumer confidence has been fairly low overall. And the answer to this comes when we dig a little bit deeper into the consumer spending data and actually look at household patterns in terms of what spending has looked like. And when we drill down, what we notice, what we find is that a bulk of the increase in consumer spending since 2021, since May of 2021, when inflation began to rise, most of that has come from higher income households in the US. And you can see on your screen there how we define higher income households. And these higher income households have been, again, the ones that have been disproportionately contributing to spending activity. And so if we just explicitly compare the level of growth in this case, retail spending, just compare where we were in May of 2021. If we track that over time, again, what you'll notice is that most of the growth has come from that green line, those higher income households compared to the blue and the red. And you'll also notice that those three lines have really come apart since 2021. In other words, consumer spending, retail spending, kind of ebbed and flowed in the same direction, right? The three moved together up until 2021. Then, when inflation began to take off, we see those lines begin to pull apart. And higher income households, the green line in this case, only represents about a third of US households. So a distinct minority. So a minority of households have been driving the bulk of consumer spending, while the other two-thirds have seen either fairly stagnant growth or have been cutting back. And of course, they are the majority. And so they have been driving a lot of this consumer sentiment. So it's no contradiction that we'd see low consumer sentiment among the majority, even while we see consumer spending persist, given that it's only coming from these higher income households. So an important distinction to recognize. And this is continuing into 2025 as well. So these data go through the end of 2024, but we've seen these patterns continue into this year. Especially when we look at median annual wage growth. And what you'll notice is that higher wage industries have begun to grow faster in terms of wage growth compared to lower wage industries. This is really the norm. This is what we were used to seeing before the pandemic began. And in 2021 and 2022, because of very high levels of labor demand, for a period of time, we saw lower wage sectors begin to catch up. And so the overall level of wage growth was more comparable between higher wage and lower wage sectors. But now we're, again, reverting back to pre-pandemic norms here. So this suggests that a lot of the growth in spending going forward is going to be with those higher income households. That also has implications for the housing market. So we've talked about consumer spending overall, but keep in mind that one of the factors in terms of home buying when we look at different price points is income levels, of course. And so what this points to is one reason why we've actually seen a decline in the share of first-time home buyers as a percentage of total sales. And I'm going to come back and talk about that in a moment and show you some data on how we've seen a decline in that percentage. But this is one major reason why we're seeing fewer first-time home buyers right now. Again, because people who were first-time home buyers tend to be are going to be younger. They're not going to be necessarily at the higher end of the income distribution. And so since those are the households that have cut back or are not growing in their spending, one area that's going to affect is their demand for housing. So this has implications for trends in home buying. And again, we'll get back to that here in just a moment. So that's really the bad news in terms of spending activity, in terms of this loss in purchasing power. But the good news is that we are beginning to see consumers claw that purchasing power back. They haven't gotten it all back yet, but wage growth has been consistently outpacing inflation throughout 2025. So our current rate, you can see here comparing wage growth at 3.9% to inflation. The latest data show 2.7%. So clearly, consumers are beginning to get that purchasing power back. But again, we still have a long way to go because consumers lost considerable purchasing power in 2021 and 2022, and that's continuing to be a drag on economic growth into 2025. So how can we actually measure the performance of the economy then? That looks at how consumers are feeling, right? We've been looking at consumer confidence, and we see that confidence has been low in part because of the loss in purchasing power and high inflation. That's had an impact on the distribution of spending and growth in spending, where we've seen a greater percentage of spending coming from higher income households, which, among other things, is affecting the percentage of home buyers or the percentage of first time home buyers. And so that impacts where we see home buying concentrated this year. And we've also seen the low consumer confidence that has been exacerbated by the introduction of new trade policies and the back and forth and the uncertainty that has created. So what does that tell us then about economic performance? What are we actually seeing and observing in terms of economic activity, getting beyond just overall perception? Well, so far in 2025, we have seen a bit of a deceleration. We're still seeing positive growth overall. So South Carolina's economy and the U.S. economy is still growing in a positive direction, but growth has definitely decelerated in 2025 compared to where we were in 2024. And the way that we can see this is well, there are a number of ways, but one easy way, perhaps the easiest, is to look at overall GDP growth, which you can see here. Was 1.3% in the first half of 2025. And you can see that is a significant difference from what we were seeing in 2024. So coming off of 2.4%, you can see highlighted in blue here, 2.4% in the fourth quarter, dropping to 1.3% in the first half of 2025. And in general, growth in 2024 was between 2 and 3%. So a shift here. And the bulk of that change has come from a reduction in consumer spending because of the ongoing effects of the loss in purchasing power and the greater uncertainty that consumers are feeling. Again, consumption overall is still positive. We're still seeing consumers spending moving in a positive direction. We're still seeing growth. But again, much weaker growth or more muted growth, we might say, in 2025 compared to what we've seen in 2024. And more broadly, when we look at why this is the case, the underlying change that we've seen this year is the introduction of market uncertainty that has really replaced a pandemic bubble market correction. So if we look specifically at housing, we've been going through a period where housing has been in effect in a mini bubble that peaked back in 2022 and has been going through a correction. And we'll look at some trends and illustrate that in a moment. And that correction largely was we went through that correction and we were in a position in 2025 to begin seeing more positive growth. But we've seen that correction in large part replaced by this market uncertainty. And so as a result, in 2025, while growth has been positive, it's been perhaps weaker than we might have otherwise expected. So market uncertainty replacing that pandemic bubble market correction that we've been seeing for the last several years. So can we illustrate this? Yes, this is very easy to see. If we look at consumer spending patterns overall, so let's start at a 30,000-foot view and look at consumer spending for the US as a whole. And what you'll notice, if we break it down into the goods sector and the services sector, is a significant spike, that pandemic bubble, which is really a goods bubble that peaked in this for the goods market overall in 2021. And this is because we saw in 2020 and in 2021 $6 trillion in federal stimulus that was largely accessible to American households in the form of stimulus checks, in the form of tax credits, in the form of enhanced unemployment insurance benefits. And so those dollars were then spent by households, but they were spent in the goods sector, not in the services sector. Why? Because we were all staying home, right? We were all socially distanced at the time. And so we weren't going out to eat, and we certainly weren't getting on an airplane. So we saw most of those dollars flow to the goods sector. We saw that goods bubble then peak, as I mentioned, in 2021, and then it began to taper, to go through a correction period. And we have now gotten to the point where that durable goods bubble is now fully deflated back to its long run trend. And that basically occurred throughout 2024. So that's the reality overall at the 30,000 foot view. But when we zoom in to South Carolina, what does that mean for our state? Well, the goods market, largely in South Carolina, is reflected in manufacturing and even more so in housing, as I alluded to before. So this goods bubble is one that you can see manifest itself in the different goods sectors across the US and within South Carolina. So just very briefly, I'll illustrate the goods bubble in manufacturing. So this is the ISM Purchasing Managers Index. This is a broad measure of manufacturing activity in the United States. And you can see that bubble peak in 2021. Anything above 50 represents an expanding manufacturing sector. So this index looks at things like sales activity, pricing levels, inventory levels, and this basically takes all of those factors into account when looking at this, when creating this index. And so you can see an expanding manufacturing sector that peaked in 2021 and has now come back to pre-pandemic norms. But also notice that we haven't seen any appreciable growth in 2025. So it has gone through its correction period, but we haven't seen any meaningful growth in 2025. Similarly, if we look at housing markets and in South Carolina, you see a similar bubble, right? We see a peak in 2021 in terms of housing sales in South Carolina, and you see us beginning to move back to pre-pandemic norms, to pre-pandemic trends. And we have actually seen that. Total sales volume has returned to pre-pandemic levels after peaking in 2021. But again, what are we seeing in terms of growth this year? So sales growth still remains below pre-pandemic levels. As you can see here, about 0.3% year to date in South Carolina compared to the average annual rate of growth of about 6% before the pandemic began. So a correction, a deflation that is now largely behind us, but still weaker growth in 2025, largely because of this market uncertainty that has emerged. That's one piece of the story. Now, in addition to sales activity, in terms of moving back and seeing this pullback from this mini bubble that emerged in 2020 and 2021, we can also see the impact on housing prices as well. So the median house price in South Carolina, in this case, it is continuing to rise. We haven't seen a decrease in house prices, right? Like we've seen a decrease in sales activity, but we have seen the rate of appreciation go down. That is to say, prices are still rising, but they're not rising as much as they were back during the peak of that bubble between 2020 and in 2022. And you can see that very clearly here, right? So you see the acceleration of the appreciation of house prices between 2020 and 2021. So the slope of that arrow ticks up, and then it falls back closer to pre-pandemic norms in terms of the rate of growth, in terms of the rate of appreciation. But house prices are continuing to rise, and as many of you know, of course, one major reason for that discrepancy, while we're seeing house prices continue to rise despite the fact that sales activity is down, is because of inventory challenges. The inventory challenge that we face across the state, where we've gone through a decade-long period of underbuilding. And as a result, those supply side effects, the lack of inventory, has kept upward pressure on prices, despite the fact that we've seen a pullback in demand. And we can look at inventory levels to see this very clearly. So, for example, if we look at monthly inventory levels in South Carolina, you can see that they have returned to pre-pandemic norms, but that still reflects an economy that is undersupplied, or reflects a market that is undersupplied. Why is that the case? Why would we say that we still have a lack of supply despite the fact that we're back to monthly inventory levels that are closer to pre-pandemic norms? And the answer is because we're continuing to see very strong population growth in South Carolina. And this is true more generally in the southeastern United States, but especially in South Carolina. And this is likely to continue as we move forward. Population projections across the US show consistently that the Southeast will likely see more population gains than any other region of the country over the next several decades through the year 2050. And South Carolina itself has ranked number one in population growth in recent years and has been consistently in the top five since 2020. So we have a scenario where, again, sales activity has declined, but prices are continuing to rise, though not as significantly as they were between 2020 and between 2020 and 2022. But the reason for that is because we still have a lack of inventory given the level of demand that we're seeing, driven by this population growth that continues to move to or continues to migrate towards South Carolina, and that is compounding the inventory challenges that we had been facing because we've been going through a period, as I mentioned, a decade-long period of underbuilding overall. Now, in the Southeast and in South Carolina, we are continuing to see more growth in terms of future housing supply relative to other areas of the country. And again, that's in part because we're seeing so much population growth concentrated in this region. So just to give you an example of that, this looks at cumulative growth, so total growth in housing permits going all the way back to 2016. And you can see that we've had overall growth across the US. So the US here in orange, the Southeast is in blue. But notice that following the pandemic, which accelerated the population growth in the Southeast, number one, we saw an increase in housing demand as measured by permits across the country. So you can see that housing bubble, right, in orange and in blue. So this clear spike. But also notice that when we saw the market correction, it occurred more for the US as a whole. In other words, we saw a bigger pullback than we did in the Southeast, right? So some very significant differences in terms of what housing markets are looking like in South Carolina compared to the US because of the strong population growth that we're continuing to see. So this is very good news when we look long term at housing demand in South Carolina. And so it's important to remember that despite the market uncertainties that we're seeing this year, and despite the fact that we've seen relatively weak growth this year in housing sales, that long-term demand remains very strong. So we continue to be very bullish about South Carolina and about housing markets in particular in the state as we look into the coming years and look out towards 2030 and again over the next 3 to 5 years. Now, what can we say about the labor market? So we can see those trends that have evolved. What does that tell us about the jobs market? Because remember, the labor market and employment growth is the single best predictor that we have for housing demand, because in most cases, people cannot buy a house without a job. And so the labor market, very important to keep our eye on in terms of tracking current and potential future demand for housing. And what we see in South Carolina, very similar trends in terms of this market correction over the last couple of years, where we've seen a pullback from unsustainably high levels of demand, particularly in the goods sector. We can see that if we look at annual employment growth trends in South Carolina. which you can see have cooled significantly since 2022 and 2023. But also notice that it's been very stable in 2025. So again, this theme of slower growth. So we've seen a deceleration of growth in 2025, but nevertheless still positive and stable. So slower but stable growth in 2025. And we can see this looking at employment trends overall. But we are continuing to see the bulk of that growth coming from the services sector, right? So we talked about that goods market correcting and going through a period of moving back towards pre-pandemic trends. And because of the new uncertainty, again, that has replaced the market uncertainty this year, that has replaced uh, that bubble correction, that deflation that we were seeing. Most of the growth is still taking place in the services sector and not in the goods market. And this is largely due to the back and forth on trade policy, which is affecting everything from manufacturing to retail trade to logistics, transportation and warehousing. So think about all of those goods sectors that are, and those businesses that are going to be influenced by changes in trade policy. And so the uncertainty that we're seeing has caused them to, in many cases, pause and again go into wait and see mode as we have gone through the summer months. And so as a result, a disproportionate percentage of our growth is coming from the services sector. And we can see this at the US level as well. Regardless of whether we're looking at employment data in South Carolina or the US, you see very comparable trends. So this looks at US employment. Again, you'd see comparable trends if we broke it down by industry in South Carolina as well. But notice that the primary goods sectors, again, they've seen either fairly muted or slow positive growth, or in some cases negative growth. And again, that the reason we're seeing that in the goods sector is primarily because of that market uncertainty, and that is coming on the heels of this correction that the goods sector was going through over the last couple of years. So we've replaced one factor with another, but in both cases, it's leading to fairly sluggish growth in 2025. You can see the sectors that have primarily been driving growth at the US level. This is similar in South Carolina, healthcare, to a lesser extent, education, and leisure and hospitality, which has done very well in South Carolina as well. Healthcare has been the number one industry driver for growth in South Carolina over the last 2 years. Again, largely because of the population growth that we've been seeing in the state. And much of this growth has come from an increase in demand overall for healthcare, but also because we have more and more retirees moving into the state. So healthcare is going to continue to be a major driver for South Carolina. And really what this shows us more broadly is that we're in a no hire, no fire economy. This is a term that many economists have started using. And I think it's very apt. I think it's very accurate. So we are in an economy that's very, very stable in 2025, but as I mentioned, very sluggish growth because of the uncertainty. And so from a business perspective, we see a lot of companies that are basically in that wait and see mode, right? They're still seeing levels of demand that they want to make sure that they're able to meet. We are still growing, but because of the uncertainty, they're really not looking to hire. So employment growth has cut back this year. But at the same time, they're not looking to lay off any workers. They're not looking to downsize. So they're very much in this mode of wait and see. In this, they're almost kind of in a sense they're orbiting, right? They're just in a pause, and they're waiting to see where we are likely to head, what market conditions evolve to in the second half of the year. And in the meantime, in this no hire, no fire economy. And we can see this very easily, again, in the data. These are not subtle patterns. So one way to see the no hire or the no fire, no hire economy is to look at total growth in unemployment insurance claims. And you can see this very clearly. So unemployment insurance claims are a way that we can get a sense of the number of people who are being laid off and how long they are without a job. So initial claims, so this looks at growth in initial claims and continued claims going back to 2023. So the orange line is the growth in initial claims. So the number of newly laid off people. So this is just a measure of whether or not we're seeing an increase in layoff activity. And what you can see at the US level is the answer is definitely no. We are not seeing any uptick in layoff activity. So that's good news. In other words, the rate at which companies overall are laying workers off is comparable to what it was back in 2023. But on the flip side, if we look at continued claims, that is the number of people that are, when they do file for unemployment, how many weeks do they file? How long are they filing for unemployment? That has actually gone up compared to where we were in 2023. So you can see in the blue line, we've seen an increase compared to where we were 2 years ago. So if you are unemployed or if you lose your job, it's taking you longer on average to find another job, but the rate at which people are being laid off has not gone up, right? So a no fire, no hire, or a no hire, no fire economy is you can see that very clearly when we look at the data themselves. We can also see this even more simply if we look at the percentage of people who are unemployed. Of all the people who are unemployed, what percent are unemployed by more than 27 weeks, right? So that's actually gone up by a significant percentage since 2023. So again, people are not more likely to be laid off, but they are more likely to, or they're going to have a harder time finding work once they are laid off. Again, a no hire, no fire economy. And this also translates into what we're seeing for younger workers as well. So another recent trend that we've seen emerge is that unemployment has gone up for younger workers, specifically recent college graduates. So normally we see that recent college graduates in their 20s tend to be more likely to be employed relative to all workers. In other words, they have a lower unemployment rate on average. That has historically been the case. And you can see that here with the blue line typically being below the black line. But that has reversed in recent years and has seen a pretty significant uptick in the last 6 to 12 months. And so this reflects the fact that companies who are slowing down their rates of hiring, if they are going to hire, they're probably less likely to hire a younger person who may have less experience if they're having to make that choice. So again, this reflects a no hire, no fire economy. And it also has implications for home buying specifically. I mentioned before that we are seeing lower rates overall of home purchases by first-time home buyers as a share of total purchases, which you can see here. We've seen a downward trend in recent years, but 2024, the latest year for which we have data, this has come down. Part of this is because we're seeing younger workers who are less likely to be hired right now. And the second reason is because we've seen that loss of purchasing power. And as we mentioned, the upper or higher income households have been the ones that have been driving a lot of the consumer spending in the US. And those households, when they're buying homes, are less likely to be first-time home buyers. So you can see multiple patterns in the data in terms of spending and in terms of hiring practices that have generated this new phenomenon where we see that the share of existing home purchases by first-time home buyers has actually gone down and is at the lowest rate that we've seen in recent years. Okay, so let's change gears then and look to the future. So we've seen trends that have emerged in 2025. We've seen that growth in 2025 so far has been positive, but fairly weak, right? Slow, a slowing, a deceleration of economic growth, but still positive and still overall stable. And that has been true when we look at when we look especially at the labor market and especially in South Carolina, where we have a lot of demand that is continuing to be driven by population growth that is fueling especially demand for housing. So what can we say for the second half of the year and looking ahead to 2026? What's the outlook for housing markets nationally and especially here in South Carolina? Well, there are two factors that we want to look at, two major drivers of demand that are important to recognize. One is job growth, right? As we mentioned already, If you don't have a job, you typically can't buy a house. So job growth is going to be very important for the outlook, as well as affordability. And affordability remains a challenge. Housing affordability remains a challenge. So we want to look at both of these to get some insight into what we can expect going forward and how these two might evolve in the second half of the year and looking ahead to 2026. So first, let's look at job growth. So what can we say about the outlook for the labor market, for job growth as we move into the move through the second half of 2025 and looking ahead to 2026? Well, remember that when we're looking at the labor market, when we're looking at job growth, we want to start by looking at consumer spending because consumer spending, consumers represent 70% of GDP, 70% of the economy. So consumer spending becomes very important and predicting consumer spending, looking at what factors are going to be driving consumer spending in the coming months becomes important as well. And so when we look at these data, what do we see? Well, we can start by looking at consumer spending growth overall. Again, goods and services. So we're looking at all consumer spending now and just look at changes in growth rates over the last several years. And what you can see is that, as we mentioned before, even though consumer spending has been positive in 2025, it has seen a marked shift compared to where we were back in 2024. So growth in consumer spending still positive this year, but has nevertheless slowed. And so the question is whether or not that's going to continue going forward. And what can we expect? Or do we expect it to bounce back? Do we expect it to continue to drop going forward? And so we can look at leading indicators that give us some insight into where consumer spending is likely to be in the coming months. One leading indicator is looking at the U.S. delinquency rate on all consumer loans. And when delinquency rates go up, that typically suggests that we're going to see a downturn in consumer spending going forward. And so far, we are seeing delinquency rates that are at very healthy levels. So 2.77%, the latest data that we have, that's a first quarter measure. We have some preliminary data in the second quarter, not an official measure yet, that suggests that delinquency rates still are at healthy levels. But really, a delinquency rate on consumer loans, anything below about 3.5% to 4%, is where we want to see it. In other words, if we get above about 3.5% to 4%, that's where we begin to see financial institutions look at that and say, yeah, you know what, this may be a yellow or an emerging red flag. So right now, consumer spending, again, looking to be stable as predicted by the delinquency rate, which is still in fairly good shape. If we look at personal income, this is another measure that's going to predict consumer spending, all right, because income levels, when they ebb and flow, that's going to, of course, generate changes in consumer spending. Here we have seen some pullback in real personal income levels in 2024 and 2025, but still overall very compatible with positive growth, albeit, again, the weaker growth that we have seen in 2025. So no emerging red flags here. Personal growths or personal income levels and income growth rates still seem to be moving in a positive direction and a fairly stable direction through the summer months of 2025. And then finally, we can also look at industrial production. So this a broader measure of business activity. So just what does overall economic output look like from an industrial perspective? So how are we doing compared to where we've been in recent years and compared to where we were before the pandemic? And again, in this case, we see a lot of stability here. So production levels are very comparable to what we've seen in the last few years and certainly comparable to pre-pandemic trends. So the bottom line here then, when we look ahead and we look at factors that show both current activity and what might predict changes in consumer spending, which could affect the labor market, what we see is that the U.S. consumer, along with the job market, both remain fairly stable in 2025. But the key is that there is not really much room for further cooling, right? So we've gone through this market correction over the last couple of years. We are in a period where we've seen increased market uncertainty that has caused some pullback in overall consumer spending, but we're still seeing positive growth. But again, there's not much wiggle room for further cooling as we move ahead. So that when we look where we are today, as long as job growth remains at current levels, as long as we see these trends continue where we are, we're still in good shape to see positive growth in the second half of the year. That is to say, we are not anticipating a recession at this point. Now, that's job growth. The other factor we have to look at when looking at housing demand, remember, employment growth is the single best predictor, but we also have to look at affordability. And affordability, of course, has seen some challenges in recent years as well, as we're all familiar with. And we can go back and look once again at the median house price. And again, as we talked about before, house prices are still rising. They're not rising at the level that they were between 2020 and 2022, but they're still going up. And so this means that affordability continues to be a challenge in South Carolina. This is also exacerbated by the fact, of course, that mortgage interest rates are fairly high, close to 7% right now. And so the big question then, as we look ahead, especially on interest rates, is whether or not we're going to see mortgage interest rates see any significant pullback in this year, in the second half of 2025. And at this point, I think that is unlikely. We may see a marginal change, but in general, mortgage interest rates are unlikely to see any major pullback in 2025, and for a very specific reason. And that's because even though the Federal Reserve may lower rates, may lower the federal funds rate beginning in the fall, beginning in September, that doesn't necessarily or guarantee that we're going to see that translate into lower mortgage interest rates. For example, so this graph here illustrates the 30-year mortgage interest rate and the federal funds rate. And you'll notice that in 2024, we saw the Fed lower rates, but mortgage interest rates stayed fairly flat. And so the question is, why did that happen? And the answer is inflation and how inflation impacts the outlook for the US economy. So if you are a financial institution and you are looking at lending money to a potential home buyer, you have to be thinking not just about the short run, but about the long run, right? So if you're talking about a 30-year mortgage interest rate, then you're taking into account where you expect inflation to go in the coming years. So if inflation is expected to be higher, then you're going to have to issue a higher mortgage interest rate in order to make sure that you hedge on that risk of rising prices, that risk of higher inflation. So the bottom line is that when the expectation of higher inflation is a reality, when businesses and consumers are expecting higher inflation, then you're not likely to see as much of a relationship between the federal funds rate and mortgage interest rates. And what do we have right now? What do we have right now? We have high expected inflation going forward, relatively high, I should say. So the 1 year expected inflation rate, you can see here, two separate expectations, one from the Federal Reserve Bank of Cleveland, which expects for inflation to basically stay between 2.5% and 3% over the next year. Consumers expect inflation to be far higher, 6.6%. Fortunately, we do not think that is accurate. But you can see how consumers and businesses and financial institutions can sometimes differ. But the main point here is that that financial institutions do not see a significant reduction in inflation as being something that we're likely to see in 2026, which means that if we do see the Federal Reserve reduce rates this year, that won't necessarily translate into a significant decrease in mortgage interest rates. So that has implications for housing affordability as we look ahead. And it's also another reason why tariff policy and its relationship to inflation is such an important factor for gauging where we're likely to head in the second half of the year. Inflation is really the wild card. That's if you had one metric that you were going to keep your eye on to give you insight into the momentum of the economy and the housing market in the second half of the year and going into 2026, that metric is going to be inflation. And tariffs, as we know, have the potential to put upward pressure on prices, making it harder for consumers to continue spending at current levels. So, depending on whether we see an uptick in inflation in the fall, that's going to have an impact on what the Federal Reserve decides to do, and also is going to impact mortgage interest rates. Because remember, consumers are still down compared to where they were right before the pandemic in terms of their changes in purchasing power. So even though they're clawing that purchasing power back, we're definitely moving in the right direction. But average hourly earnings have increased by about 22% since May of 2020. Prices overall have increased by about 25%. So we don't want to see anything that is going to exacerbate that loss in purchasing power. So we don't want to see inflation tick up significantly in the second half of the year. Now, is it? What have we seen so far? What did the latest data show? Well, if we look at overall inflation, we can see that, again, the latest number, 2.7%, our current inflation rate. So far, we've seen that the impact of tariffs have been fairly minimal in terms of consumer prices overall. But we don't know whether or not that is going to continue in the coming months. Are we going to continue to see an uptick in inflation, or is it going to remain stable at between about 2.5% and 3%? We have seen in recent months inflation begin to tick up slightly. So, for example, even though 2.7% is the headline number, if we look at the different average rates of inflation, you can see that in recent months, in the short run, it's begun to tick up. So for example, in 2025, if we just look at 2025, inflation up about 1.9%. If we look over the last 3 months, up about 2.3%, and about 2.4% just for the last month. So in the short run, if we look at these short run effects, we've begun to see a bit of an uptick. And the question is whether or not it will stabilize, or whether we're going to continue to see increases in inflation in the fall. And we can talk more about that in the Q&A period. But the bottom line is that is the wild card. We really don't know what the ultimate effects of these tariffs are going to be. We've seen some evidence that there's going to be some uptick in inflation, but again, we don't know where that's going to land. And depending on whether we do see an acceleration or not, that's going to heavily influence what the Fed decides to do at their September meeting. So wrapping up, what is the bottom line as we look ahead to the second half of the year? South Carolina's housing market, very stable, positive and steady, positive growth and steady price appreciation so far this year. But that rate of growth, as we've talked about, remains very sluggish and shows that we are still seeing affordability challenges. We also see a slowdown in the labor market and just more general market uncertainty this year that is keeping many potential home buyers on the sidelines. And that's really impacted consumer sentiment, which remains low. And that's moved us from a seller's market much more towards a buyer's market. However, at this point, we're, again, not anticipating a recession. Slower growth, yes, in 2025 compared to what we saw in 2024. But inflation is that key factor, the key wild card, the big unknown that we're seeing. If we do see inflation rebound into the fall months, that, of course, is going to limit what consumers are able to do in terms of spending activity, will likely keep sales levels fairly weak in 2025. But on the flip side, if we see inflation that remains at its current level or begins to tick back down, that would make it far more likely that the Fed would lower rates. It would also lower the expected inflation rate in 2026. And that could have an impact on, at least marginally, on mortgage interest rates. But overall, right now, again, positive growth for the second half of the year. But at the end of the day, we are likely to see positive growth in 2025, but slower than what we saw in 2024. So I will stop there. Thank you all very much for your attention. And I'm going to turn it over to Alan now, and he's going to help me facilitate some Q&A for the remainder of our time this afternoon.
Good afternoon. Thank you, Dr. Joey Van Nessen. Great presentation as always. We do have a few questions, but I didn't know if we could talk about something that's hot off the press this morning with the PPI rate.
Yes.
Coming in at 3.3% annual, which is the highest increase in quite some time. and over month at 0.9%. This is showing signs as the tariffs are coming in that prices are going up, which will relate to the CPI going up as well, which probably in September meeting is not looking as bullish for a Fed interest rate cut of 50 basis points as well. I read earlier this week. I think that's probably diminished based off this news. But could you provide us an update of kind of where this lies? And then should Powell consider interest rates with this new knowledge coming in?
Sure. So that's a great question, and that has really been a big question for economists and really for everybody is prices are going up because we are seeing these new tariffs. The effective tariff rate has gone up significantly since January. And so the big question is who's absorbing these price increases, right? And there are multiple options. So you can look at the importer that may absorb it. You can look at the distributor or the wholesaler, or you can look at the retailer and the consumer, right? So there are multiple points on the distribution channel. And this is what we've seen with the PPI is that the data are starting to show that these wholesalers are basically having to absorb some of these costs, and we're actually seeing that. And the big question is whether or not they do pass it on to the consumer. Historically, we tend to see when you see a tariff early on that this is the process where producers basically absorb a bulk of those costs up front because every business is hesitant to pass it on to their customer, right? Whether their customer is the retailer or the final consumer. But ultimately, we expect for more of that cost to be passed on to the consumer. And usually there's about a 60-day lag there. So this is a leading indicator that suggests that we may see an uptick in inflation in the CPI between now and the end of the year. And to your point, that is going to impact what the Fed decides to do. And they're in a very difficult position because this does provide evidence that we may see inflation go up in the coming months. But at the same time, another big headline in the last week was the downwards revision of the jobs report. And so we've actually seen 3 months now of very weak job growth, which again, the Fed also has to take into account because they have that dual mandate. At the end of the day, they have a dual mandate to maximize employment, right? To maximize job growth, but also keep price stability. So they're really in a tough position, and I think we're going to have to wait and see. We are going to have more data come out before the Fed meets in September, and I think they're going to be looking very closely every day at these new data points that emerge.
Yes. And so we have another question. It's kind of in the same realm, we'll say. The accuracy of the data that we're receiving for employment rates, I think what pre-pandemic company response rate was around 60 to 80%. Now we're looking at 40%
Yes.
post-pandemic. So, are the numbers accurate enough that these decisions that we're making, do they support the full picture or just the limited view that we receive on the data that's coming in?
So I'd say in general, the BLS really is the gold standard for these jobs and inflation figures. So they are accurate. But it's certainly true that the response rate to the surveys has gone down, and that is a real problem that they are going to have to take a closer look at to try and address going forward. But the real key when looking at these figures is to compare. If you really want to get a good comprehensive profile and make sure that there's no one data source that's missing anything, you have to compare different independent sources. So, for example, I was less surprised when we saw these employment data revisions come in because we had seen a slowing economy in multiple private surveys for job growth, as well as GDP growth, which had been down. So there were a variety of measures that suggested a slowing economy, and the BLS numbers were actually the outlier, showing very strong job growth. So when we got those revisions, those basically came into alignment with what we were seeing elsewhere and painted a very consistent story. So it's important to look at multiple sources. But overall, the BLS provide very good data. But because it takes longer and the survey responses are weaker than they used to be, those revisions can be bigger. But ultimately, it's a question about how quickly you want information, right? So the more accurate you want your data to be, the longer it's going to take to get that information in, and that's why they issue those revisions. So you can get a quick snapshot, and they get more accurate information down the road as more information becomes available.
Thank you. And then we're going to an earlier slide that you had in your presentation, where it's showing wage growth outperforming inflation. And I guess the question is, can you explain that if the wage growth is higher than inflation, shouldn't inflation be ticking up as wage growth is higher?
Yes, and wage growth is certainly a component of inflation, no question about that. And when we look at different measures and breaking down the CPI, we can look at what factors are driving it. And the service sector has largely been driving part of that inflation. Again, especially in 2021 and 2022, where we saw a surge in wages. That was a big piece of it. But that's not the only cause, because wage growth is also driven by productivity gains. So when you're looking at paying someone more, you typically do it for two reasons, right? You're either going to do it because they are more productive, they're producing more in a given amount of time, or you're going to pay someone more because you're worried about them getting stolen from your competitor across the street.
Mhm.
Now, if you're worried about them being stolen, so a general uptick in labor demand, that's going to be inflationary. But if workers are being paid more because of productivity gains or productivity growth, that is not inflationary. And so what we were seeing in 2021 and 22 was more inflationary because it was primarily based on an increase in labor demand. What we're seeing now, and what we tend to see in the long run, is wage growth mostly driven by productivity gains over time, and that helps to keep inflation in check. So there are two elements there that we have to focus on. But that's a great question, because you really don't want your wage growth coming exclusively from demand, because that is going to generate higher rates of inflation.
Thank you. And we'll stay within the job realm. And so we have a question with the deportations that have kind of enhanced this year. Is that having a large impact in the service industry for building starts? And is that impacting the industry overall and potentially leading to higher prices and new builds?
Yes. So the short answer is yes. We do have some anecdotal data from businesses that is having an effect on, particularly in construction, also in agriculture and in retail, just in terms of scarcity of workers, and that's putting upward pressure on wages and just making it harder to complete projects. We don't have specific numbers that we can put on that,
Mhm.
but it is certainly a factor, and I think is one factor among several that's putting upward pressure on prices and keeping inflation from ticking down towards 2%.
Okay. And this will be a good segue into the next question. What is so magical about the 2% inflation number? How
Ah,
long
oh,
has it been
that,
pegged at that level? And why have we not revised it or realized that reality is 2% might not be our norm anymore?
yes. So great question. Great question. So where does the 2% come from anyway? So it turns out that the 2% inflation rate was uh, decided by the Fed back in 2012 in the aftermath of the Great Recession. And at the time, the goal wasn't to get inflation down to 2%, it was to get it up to
Oh,
2%,
yeah.
because we had, as we all remember, of course, we're coming out of the Great Recession. Demand was low, especially in the housing market. And so trying to get job growth and economic activity high enough to where we could get inflation back to 2%. It's not a hard and fast rule. So if you look back to the late 1990s and early 2000s, inflation regularly ran between 3 and 4%. But that was a goal that the Fed put in place, and there is a good argument that may not be realistic or may not even be desirable going forward. There's no
Mhm.
reason we can't have inflation closer to 3% and that be fully compatible with economic growth. So and the Fed has actually changed their definition slightly since the onset of the pandemic. It used to be to get inflation to 2.0%. Now it's to get it to average 2.0% over a period of time, right?
Oh,
Which gives it a much longer window for getting inflation down if it only has to average as opposed to get down to that specific number. So it's tweaking it, but I think there are some, again, without going too far into the weeds, there's some good arguments why you could say that inflation closer to 3% is a reasonable goal. Um, the main argument against that, though, is that when the because the Fed has set a specific target, if they don't enforce it, then it makes them less credible in the future. So if they come out and say, we're going to get inflation down to 2%, and businesses are planning on it, planning on Fed policy with the understanding that that's their goal, and then they come back and change their mind, that can undermine some of their credibility. So that's also at play. So there's a lot going on there, but fundamentally, to get back to the core of your question, no, there's no reason we can't have inflation closer to 3% and have a strong economy.
thank you. And we have two questions I'm going to kind of combine, and one question I can answer real quick. It's what rate came in this morning. So the PPI report came in, which is the U.S. Producer Price Index, which is just an indicator of pricing and how it will impact the CPI. But you can look up that rate. But the year-over-year rate is 3.3%, and the month-over-month was 0.9%. Now getting back to the final question, and I will combine the two questions because they're both similar. But can you explain why imports are negative to GDP? And of the trading partners that we have currently, what increased tariffs will have the most likely adverse effect on our economy?
So why are imports count negative towards GDP? That's because um, when you look at gross domestic product, we're talking about what is produced in the U.S. So that's why I call it domestic, right? Gross domestic product. And so when you are looking at consumer spending as part of that, you're purchasing goods and you may be um, purchasing goods across the board. But anything that is purchased from overseas is counted as part of consumer spending, but it's not actually produced in the US. So you have to back it out. Does that make sense? So if you're counting all consumer spending, including what you're spending outside the US, and you only want to count it as what's produced here, then you have to subtract that out. So that's why we take out imports. So you often hear net export activity as a measure. So, and that's just exports minus imports. So it's basically a way to keep from double counting, given that we're picking that up in the consumer spending data. As to your second question regarding which which tariffs are likely to have the biggest adverse impact, I would say that from South Carolina's perspective, we're very much an export-oriented manufacturing state. That's the primary driver of our growth is manufacturing, particularly in the auto sector. So I'd say for South Carolina, any tariffs that are going to have a disproportionate effect on the auto sector likely are going to be the ones that have the biggest negative impact on South Carolina. In terms of positive impacts, it's going to be any effect that could, or any tariff that could potentially generate more manufacturing onshoring and would generate a scenario where South Carolina becomes more competitive. So that's really how you have to how to look at these costs and benefits, because the downside is the increase in costs. So auto manufacturers are having to import materials that are more expensive. But down the road, do we see more manufacturing investments in South Carolina? We could, but that's again, the short run effects are the costs, the higher prices. The long run benefits can take months or years to materialize.
Thank you, Joey. And we do have one last question that just came in. And it's a measure that I'm not sure the answer to, so I find it kind of interesting as well. But when we're looking at affordability, job growth in South Carolina, often what we're seeing now is cash buyers.
Yes.
and especially in the retirement sector. Is there a tracking on, cash buyers uh, when we're looking at affordability to kind of decide, hey, the X amount of houses are being sold and it's all cash. Is there a metric out there that kind of follows that?
So the best metric, I'd say the short answer is no. I don't know that there's anything that tracks that explicitly, but we do track population growth by age, and if you look at people moving into the state over the age of 55, that's where you're more likely to see those types of transactions, because these are often, as you would expect, wealthier individuals who are either retired or are coming into South Carolina for their last job, looking to retire in the next decade and are more likely to have the resources to engage in a transaction like that. Um, Now, people over 55 have been a very steady um, source of demand. I think that's more likely to go up over time than down, given the recent trends that we're seeing. So while we don't have a specific number for that measure, I think the number of people over 55 moving in is the best proxy for it. And that has been very stable. And if anything, I think that's likely to go up in the next several years.
Well, thank you. I believe that's it for our questions today. As always, great presentation, very informative, and a great resource for our members. Is there any final thoughts you have for us? Or how's Carolina going to look this year?
Oh yeah, yeah. No comment on that one. But no, hopefully we'll have a good year, and yeah, looking forward to the fall and some cooler weather too. Probably not anytime
Yes.
soon, but maybe a little after Labor Day. We'll see. But
Yeah.
no, thank you, Alan, and many thanks to everybody for participating today. And if anyone has any follow-up questions, feel free to email me. You can reach out to me directly or through Alan or through Sharon. But many thanks to everybody for participating, and we look forward to seeing you next time.
And I have a couple of plugs real quick before we completely go. But if you're not registered yet, please look into our SCR Legal Conference down at Wild Dunes in September. By participating in this, the first 20 registrants from this presentation will be eligible for a $20 off their registration fee. And you can find this at screaltors.org/realtormania. And the promo code for the $20 off is economic. So, but yes, thank you so much, and look forward to seeing you all in the next update.